Welcome back to Sense and Sensibility. Today, my friends in finance, let's talk about why dividends seem to have disappeared, even though companies are making just as much money as ever. Personally, I'm always on the lookout for a company with a good dividend. But these days, it seems it is getting harder and harder to find a good dividend yield. But for most of market history, dividends were the way companies paid shareholders. If a business had extra cash it had no use for, it simply paid the money out. Dividends were considered an integral part of an investor's return, and if a company cut their dividend or just did not pay out a dividend in the first place, investors would be fairly concerned and skeptical about the company's long-term viability, and they definitely would not view not paying dividends as a strategy. Contrast that to today. Since if you look at the S&P 500, the dividend yield is only a little over 1%. Historically, it used to be much, much higher. So what changed? Dividends didn't disappear because companies got greedy. They disappeared because an alternative to dividends showed up. That something was stock buybacks. Buybacks quietly do what dividends used to do: return value to shareholders. They increase ownership per share, boost earnings per share, and they're far more flexible. A company can slow or stop buybacks without causing panic. Cutting a dividend, on the other hand, is seen as a public admission that something went wrong. Taxes also quietly hurt dividends more than most people realize. Dividends are taxed the moment you receive them, whether you need the cash or not. That creates an immediate tax bill. Buybacks, on the other hand, increase the value of your shares without triggering taxes until you choose to sell. Once investors and management understood that difference, dividends lost a major advantage. At the same time, the economy shifted. Modern companies, especially tech-focused companies, don't always need massive upfront capital investments in factories or inventory these days. So when they can, they will reinvest their cash at high returns. So keeping money inside the business creates more value than paying it out. At the same time, value investing-oriented approaches started giving ground to more growth-oriented approaches. And so investors begin looking to invest in the next big companies who are going to grow at mind-boggling rates every year, rather than a humble and not a little bit boring company that is paying out a solid and consistent dividend, and with a share price that is slowly plodding along. That's why companies like Apple, Google, and Amazon didn't build their shareholder returns around dividends. They built them around growth, reinvestment, and ownership expansion. And dividends haven't vanished entirely. They're still around, and even thriving in some industries. Utilities, banks, and consumer staples still pay them, because their businesses are mature, predictable, and capital heavy. And even some big tech companies like Apple and Google have grown and matured to the point where they have started paying a very modest dividend of 0.5% for Apple and 0.25% for Google, which will not make a huge contribution to the returns of these two companies. The other problem with dividends is that even if all of the S&P 500 started paying out all of their earnings, they could only pay out a fairly wimpy 3.33% dividend. And even if they started paying out a little more realistic 50% of their earnings, they could only provide a yield of 1.67%. So it often makes more sense for the company to reinvest the money and grow earnings that will be valued at 30 times rather than pay out their earnings in a way that is fairly unimpressive. Even if it is logical and makes sense, the decline of dividends does make me kind of sad though. Because nothing beats getting a metaphorical check in the mail, rather than relying on the market. So dividends didn't disappear. They just stopped being the default. In today's market, companies still return cash to shareholders, just in quieter, more flexible ways.
Thanks for watching. Remember, this isn't investment advice. just stuff you should know. Please like, share, and subscribe so that you and I can continue our investing journey together.